I think humans and investors in general drive on fear. So whether it's the fear of missing out or the fear of losses.
Leverage cuts both ways. It amplifies your returns on the way up, it amplifies your losses on the way down.
Hello, everyone, and welcome back to ETF Market Insights. I am your host today, Zayla Saunders. I'm stepping in as a guest host this week. For today's episode, we've got a very fun one. We are driving into a very hot topic that seems to come up at every dinner party, and that's the question, stocks versus real estate. To help us break it down, we've got two incredible voices. Before I introduce them, just a very quick reminder, we are not providing investment advice or recommendations. As always, today is about information and education. So my guests today, first, I have Dan Foch, the host of the Canadian Real Estate Investor podcast, where Dan breaks down everything happening in the housing market and what it means for investors. Hi, Dan.
Hey, thanks for having me.
Excited to have you. And the other half, the other different half, we've got Simon Bélanger. He's the host of the Canadian Investor podcast. So Simon's focus is the long-term investor, public markets, and helping Canadians understand the investable stock universe. So Simon, welcome.
Yeah, thanks for having us.
I'm very excited to have you guys. So this is a hot dinner topic. Before we jump into it, when you guys are at a party, do you get pegged into a corner? And do people ask you stocks versus real estate, knowing what you do?
Most people avoid asking me this question or anything related to the housing market because they know that I want to talk about it more than they do. So they save themselves the time, to be honest.
They're going to get stuck in a corner with you the whole party.
For sure.
Yeah, and I'd say for me, it's more people asking about like the hot stock right now or recently the SpaceX IPO would have been a hot topic more than real estate, I would say.
Very hot topic. You can't escape it these days. So I'm going to start with the question maybe somebody's asking you, if you had to start from scratch today with 50,000, are you choosing real estate or stocks and why? Dan, you can take it first.
Well, there's not a lot of markets that you can really have a meaningful real estate investment with $50,000. But my answer is always it depends, and we can unpack a little bit of why that is. But I would usually err on real estate via the primary residence just because I would bias to what is the average Canadian do and what wealth building tool are they looking for. And historically, real estate seems to accomplish that goal better than equities. We can unpack the reasons why, because there are important reasons why.
Okay, Simone.
Yeah, and I think Dan and I agree on this a whole lot, but for me, it's typically nuance as well. But 50,000 is just not a lot. It won't get you very far in a lot of Canadian markets. For most major Canadian cities, of course, there are smaller cities where it should be enough for a down payment. And the problem too is if you start buying real estate, is you're also heavily concentrated because you're probably just using that whole $50,000 to buy that one piece of real estate, whereas stocks, you can really diversify, whether you picked an all-in-one ETF, whether you pick different kind of index ETFs, or you build a stock portfolio. Now with fractional shares, it's very easy to get well diversified across geographies, types of companies, sectors with stocks.
So let's jump into maybe the biggest misconceptions that people have. I'm going to call them around your asset classes, but really just your areas of expertise. So maybe Simone, you want to start? Is there a lot of misconception you're seeing from investors right now?
Yeah, well, right now, I mean, people have a recency bias. So the markets have been doing extremely well for the last several decades, with the exceptions of a few small blips, most recently 2022. But if we even go back the last 5 years, I think people's expectations is the market always goes up. I think that's one of the core misconceptions right now. Volatility is also something that people get affected by. They think that because stocks are volatile, that it could really impact adversely the returns, or they may react too quickly to some volatility, because that's a big difference between real estate and stocks, where stocks are constantly marked. You can check on your phone every second, the price will change. Whereas real estate, I mean, the price may change, but in reality, you don't know, because the the last home that sold in that area was sold a couple months ago, and you can just look at that price. Aside from that, there is some complexity aspect. People think that they need to be experts to invest in stocks, but I know BMO ETFs has a ton of great products like all-in-one ETFs, for example, that allow you to get some broader diversifications. There's a lot of good options in Canada where you can do it with just one click, one ticker, and you get that diversification. So it doesn't have to be complicated. And there's also this idea that you have to time the markets. And unfortunately, it's more time in the market than timing the market that's important when it comes to stock investing.
A lot of great sayings baked in there, Simone. And I think, talking about investing, I love using that house analogy. And I know Dan, you'll speak to this, but talking about if you came up to someone and every day gave them a different price for their house, and it's kind of like the stock market, would you accept the bid? And it's your manic neighbor. And, the stock market, when you think about it as if you owned a house, you wouldn't trade stocks the way you would if someone knocked on your door every day and gave you a new price.
Yeah, exactly. I think that there's an illiquidity to it, right? So you can't sell it as easily. And I mean, to use like Wall Street bets, analogies, it forces you to be like diamond hands. You can't sell it as quickly. And I think that takes away a lot of the issues that people have with more liquid assets like stocks. The other thing is it creates a debt obligation in most cases. So, data would tell us that, unfortunately, Canadians aren't exceptional at saving money. And so, while if somebody were to follow the rules perfectly and capture the spread between the cost of renting versus owning the same home and dollar cost average that into stocks and also invested their down payment wisely and could perform even at just the S&P 500, they would actually outperform the return of not only a real estate investment, but a primary residence. But Canadians don't do that historically based on data. And so that's how the primary residence paying off a mortgage, even at the steep cost of interest over the lifetime of said mortgage, has really done a good job at forcing Canadians to save money, forcing them to store that money in a hard asset and benefiting from, the growth of the asset over time.
So Dan, what would you say the biggest misconceptions around Canadian real estate right now is?
Well, I think real estate in general, people, they think, and a lot of this is tax codes problem. Like when you collect rental income, it's taxed as passive income, but it is certainly not passive income. So when you're investing in real estate, it is like, you're running a business. And I think the biggest misconception that people have is that you are investing in something and somebody's just going to pay you every month and that's it. But like a dividend stock, it is not a dividend stock. It's taxed less efficiently than dividends, and it is not passive.
No, that's a great point. Let's talk about today's environment. Dan, I know you're really passionate about keeping up with what's going on in the economy. When we think about interest rates right now and affordability pressure for Canadians, do you see that there is a break somewhere in the future, or what's your lens around, our economic environment in the housing market right now?
Yeah, it's funny. I find myself watching macro more than most people in stocks now because apparently the stock market is completely detached from macro. Like, news that you would expect to be negative is not. So, but for us in real estate, it matters because that's what your central banks make decisions based on, and they're the ones who determine the lending environment. I would say that there will eventually be some relief. It's just whether or not it comes quickly or it takes a long time. But either you stay on the path that we're on and inflation continues to, oil prices continue to get absorbed by the consumer in both Canada and the US, and it becomes inflationary, and inflation eventually breaks the consumer and the both the central banks and the government, so both monetary and fiscal side, will have to stimulate the economy in some way. Or, oil prices do not get absorbed by the consumer, and it results in what you call demand destruction, and they have to stimulate the economy much sooner. As it stands right now on the date of recording this, it sounds like the conflict in Iran has been, somewhat resolved, but we've heard this many times before, right? So I think that there are, I don't think either path is good for the average person struggling with affordability, like you mentioned. It's just a matter of how quickly does it break the consumer economy in Canada and the US, and how quickly does that lead to rates needing to come down. If consumers can continue to absorb inflation indefinitely, I think we have far bigger structural problems with our economy that we need to be talking about.
Yeah, it's really interesting. I was on a call with a market maker this morning, and he was talking about the DIY investor and how the data is showing that the majority of Canadians are not doing well financially, but we keep seeing a lot of money from the DIY investor go into the market when there's dips of volatility. So, Simone, is that the rhetoric or the thoughts you're hearing from listeners on your podcast? Do people have cash on the sidelines, or how are they feeling?
Yeah, I think whether it's listeners to the podcast or even if you go on Twitter, X, and you follow the finance community there, I think people have been programmed to just buy the dip. And whether they have the money or not, I think there is also, I haven't looked at it in the last month or so, but I think we are at record high margin debt, so leverage to buy stocks. So that is extremely dangerous. It's great when things are going up, but when things start going down, it just amplifies your losses. So it amplifies the gain, but the losses as well. Obviously, leverage is present in real estate too, but I think that is one of the wild cards that we're seeing. There's a whole lot of hype. So I think humans and investors in general, a lot of investors drive on fear and humans as well. So whether it's the fear of missing out or the fear of losses, when the markets are doing well, the fear of missing out kicks in. And then when we start seeing a correction, is the other way around. So it's like a pendulum. And this has been shown time and time again. So I think that there's a whole lot of emotions going on in the market. You have, I mentioned SpaceX just IPO'd, and you're seeing the stock go up despite the valuation being extremely rich. And then you have OpenAI and Tropic that are planning to IPO. The speculation would be that it likely in the fall at some point as early as September. So a lot of hype, but to put some money in those companies, you also need capital. So it may have an impact on the rest of the market where people will sell some other stocks that may have been doing well that are very liquid to be able to get in those IPOs. And then you have some bigger risk in the next year following those IPOs when those lockup periods start coming up. Because right now, for example, SpaceX, it's less than 5% of the float that's actually publicly traded. And what's going to happen when early investors will want to cash out on those shares and flood the markets with shares. So that is another risk that is present right now.
It's all the talk. You can't get away from it right now. And I think for good reason, with the indices changing some of their rules and for inclusion within this whole IPO. So it is a broader discussion, I think, for investors. I don't want to spend too much time on the doom and gloom. I know we were talking about some of the risks and some things that can happen, but let's focus on, I'll go to you first, Dan. When we think about people who own real estate, I think it can be glamorized as passive income. You can own properties, but what are some of the risks maybe that you would want to highlight for Canadians who are thinking about getting into that space?
I think the biggest risk that people don't evaluate enough, or maybe they're starting to now, which is why the market is so soft, is that it's a levered bet. Like in most cases, I mean, real estate is never necessarily a bad investment. It pays a dividend reliably, right? It pays cash flow reliably. Where people start to get into trouble and play with fire a little bit is when they take on leverage. And real estate, because of the way the Canadian banking system is structured and because of the perceived security of the asset class, allows regular consumers access to leverage points that they would not otherwise get. Like there's no way I can get 20x leverage to buy the SpaceX IPO, government insured, at the lowest cost of capital available in the market. But I can do that to buy my primary residence. The problem when I'm 20x levered is, I mean, let's use that example because that's how many people buy their primary residence. So 95% mortgage, I have 4% fee baked into that. So now I'm at 1% equity, and that's before switching costs, which is, realtor commissions, land transfer tax, et cetera. So I take possession of that property in a negative equity position. It's an extreme example, but there are many people who use that type of leverage. And as we're learning right now, after the rate hiking cycle of 2022, leverage cuts both ways. It amplifies your returns on the way up. It amplifies your losses on the way down. And you also have this shot clock that's ticking the entire time where, every 5 years you have to reset at new rates. And right now we're going through the largest number of Canadians resetting at increased interest rates we ever have in history. And this is obviously having some pretty meaningful negative impacts on the market. So I think that that's probably the biggest risk that most people didn't evaluate as much as they should have over the last, basically the entire cycle since the 1990s, and now are being forced to evaluate in short order.
Interesting take. Simone, what about from your end on the investor's lens? Are there any, leverage is a big topic throughout this discussion, but where are you seeing on your side?
For risk, leverage is definitely one, concentration is another. The indices, even we talk a whole lot about index investing, and there's a whole bunch of ETFs out there that follow indices that are low cost, low fees. Those are great, but if you start looking at the S&P 500, the NASDAQ, you're looking at the top 4, 5, 6 names being in excess of 25-30% of the index and being very concentrated in one sector. So information technology or communication, depending if how you want to classify, like a Google, for example. Yeah. So there's a whole lot of risk in these companies. And when you add in some of the leverage that Dan talked about for real estate, but it's also sky high right now for investors as well, you do have the makings of potential problems ahead, especially if there's a significant correction. And like I mentioned, if you start seeing those lockup periods happen the next year or so, and you start seeing shares flood into the market, it's not impossible to think of scenarios that could see the market significantly go down. And then it's kind of, all tides, like the boat analogy where, the boats all lift and they all sink together. So even if you have some names that are not affected to that, they might also be affected, but to a lesser degree.
Simone, I feel like we've been having this conversation for what feels like years about, is it an AI bubble? Is there too much risk? And now the FANG stocks are called Mango. And I feel like it's just this perpetual discussion of, are we in an AI bubble? You're not giving advice, but what's your perspective around that? Do you agree with that thought?
Yeah, I think there's no question. If you look at history and new technologies, they always end up in bubbles. Like are we at the top of the bubble? Are we halfway through, 3/4 of the way through? I think the timing part is the most difficult. But if you look at the internet, if you look at the railways being built, it's always the exact same thing. There's a new technology that comes in and it's being overbuilt because companies do not want to get left behind. And no one really knows what the future will be, but I can tell you for sure is that in 10 years, you pick your name out of the hyperscalers, I guarantee you that at least one will have fallen from grace.
Warren Buffett's quote, right? This time it's different, the four most expensive words.
I would say, I agree with Simone's take on that, but it's like the challenge with new technologies is you're trailblazing. And so you're basically gambling, right? Like it's complete guesswork on how things are going to play out. And, you can place your best bets. And I think most of the businesses that are in the hyperscaling space, are, pretty, they have staying power. I don't think any of them are going to go belly up anytime soon, but would we see some contraction of valuation? The key challenges that you would look at, I'll start with the challenges and then kind of move into I think what I would say are opportunities. The challenges, right now, these companies and their investors are subsidizing compute for their users. And so they're, at a certain point when, SpaceX IPO, you probably have an Anthropic and OpenAI IPO left in this cycle. They will eventually have to be accountable to shareholders in a public market setting, which they aren't right now. And that eventually will lead to, Tesla has kind of defied this for a long time and some other businesses have as well. But at a certain point, they will have to produce profit and deliver value to shareholders. And that kind of creates a little bit of that would be a catalyst for obviously things. And when are investors going to actually want to see their investment be profitable, et cetera, who knows? But on the other side of things, I actually work at an AI company. So we produce AI tools for real estate professionals, basically automating 70 to 80% of the workflows that realtors do on a daily basis. And I've seen the increase in productivity. And so that I think that it is actually also bullish for the economy. It's super bullish for economic growth, provided that when we get over this period of subsidy or they can drive costs down, people can actually afford to use this technology at scale, but we don't know that yet. And that's the big question mark from my perspective.
And both can be true at the same time, right? If you go back to the .com bubble, and if you quiz people back then, at the hype of the dot-com bubble, will the internet revolutionize the world? I bet you none of them would think, like, would see where it's comes, like how far it's come since then, right? Yet it was still a bubble. And I think that's the lens I look at from is right now. Sure, I think AI will probably be more powerful and make us more efficient than we can even imagine right now. It still doesn't mean that we're not in the bubble. I think both can be true at once is my view on it. Yeah.
That's fair. And I'm also so bullish on AI, and I don't think robots are taking over. But to Dan's point, it is amazing to see the increase in productivity, and even using things like Copilot on Microsoft, just how it can amplify your productivity. And I just find you can get tasks done sooner and faster, and you're more efficient. It just makes people better workers. I feel like it doesn't replace them as workers. That's my perspective.
Mm-hmm.
Let's close things out from where we start at the top, guys. Real estate versus stocks or ETFs or investing. Give me your take on it. What would you say today?
Very much depends on the investor, but if you are the average Canadian investor where maybe you're having a hard time saving enough of your take-home income to really build a meaningful stock portfolio, and I mean the real estate market is pretty depressed right now. I would say I don't think we're close to a bottom yet, but we'll likely find one over the next little bit. Whereas the stock market's going in the opposite direction. If I'm building this sort of strategy for the average Canadian who needs a savings vehicle, I would typically err on real estate and their primary residence, creating a savings vehicle, forcing them to store money in a hard asset, and probably staying away from the volatility and risk that we just described in the stock market in the short term. Any other market, though, I probably would say stocks over real estate. So it is actually just a time-stamped thing.
Okay. And do you have any really interesting data or stats that would show in different markets when stocks would outperform, or this is just your thesis?
Like you could back test it for almost like 200 years, and it's almost always been true, to be honest with you. It's just that in order to outperform real estate, both the primary residence and a real estate investment with stocks, you have to be diligent about saving, right? You have to be a very prudent saver, and you have to be a very decent investor. So you have to at least get the S&P 500 index, which you could do just by putting it in one of your ETFs. But most people they start playing with stocks and thinking that they're rocket scientists and investing in all of this stuff that maybe they shouldn't. So if you can follow those rules, yeah, you can win. It's not actually that difficult, and that's back tested over as long as we've had both markets tracked. Were there periods of time where, had you bought exceptionally well, you would outperform with real estate? Yeah, probably when you see housing cycles like this play out, right? So 2008 in the US, Canada didn't really see it that much, but in the 90s in Canada, your stock market lagged the housing market a little bit because housing's a little bit more credit sensitive, so it typically blows off before the stock market does. That's usually where you saw those had you bought real estate in the bottom of the 90s versus the stock market during the bottom of the 90s, you would have done better in the near term.
Okay. Simon.
Yeah, and I mean, I think for me, especially if you have limited amount of money, mentioned $50,000, if you had more access to money, if you inherit a large lump sum, I think then you can make a case that you could probably buy some real estate and some stocks. But if it's only $50,000, I think right now it makes a whole lot of sense to invest in stocks. You have to be disciplined, like Dan has said, and I think that's one of the biggest issues for people is not having that discipline. So paying yourself first, saving, whether it's 5-10% before you spend anything, you actually invest it. I think you can do extremely well long term, even if you just buy an index fund, even despite what I mentioned, how it's heavily weighted towards tech companies right now. There are some sectors that are very attractive though in the economy because in the stock market, just because they're not seen as AI play. That's the reality right now. Energy, healthcare, real estate investment trusts. It's a way to invest in real estate through stocks, real economy type of companies, consumer staples, materials, miners, even small caps can have some really good opportunities for people. And especially being in Canada, I know Dan will back me up, and I've seen that firsthand with my parents that recently sold their condo to rent out. I mean, the vacancy rates are much higher now in a lot of major cities in Canada. So you can get some amazing deals for renting and you don't have to deal with maintenance, which, by the way, maintenance increases over time as the building gets older if you own a condo. But as a house gets older, you also have to factor in inflation costs for the labor, but also the material. So I think when people buy real estate, a lot of the time they kind of forget about that maintenance and even property taxes piece.
And the landlord piece. Dan, you know that part well.
Yeah, for sure. But major capex as well, right? Like you have to replace a roof or a furnace or whatever. Like these are big things that a lot of people just seem to forget. And on your primary residence, you don't get to recapture that as a cost, right? Like, yeah, it's tax advantage to the upside, but it's also tax advantage to the downside because you can't tax deduct those major capexes. I would say like one of the other misconceptions that I think people have is that their primary residence is an investment, and I have sort of said like I do think that it's the best wealth building tool for most Canadians, but that's because most Canadians need a savings vehicle and that stores their wealth. But it's not an investment, right? It is a liability, and it's basically a debt that you amortize over time that is also attached to the hard asset of real estate. And I think that one of the bigger misconceptions, like 70% of their Canadians think that their home is a good investment. And the reality is that it's not even an investment, right? It's a liability. So that's a very important piece and misconception that I think most people miss.
You guys highlight a lot of really good points. And yeah, something like ZSP, which is the BMO S&P 500 ETF, broad market index, low fees, you could just do that over time. But what I'm hearing from you guys is it's not really a question of real estate versus stocks or ETFs. It's saving over time, being disciplined, low cost in terms of fees, and then, of course, in leverage as well. So it's kind of all of those things. And if you have capacity to do both, great. But I think do you need that forced saving habit through real estate, or are you disciplined enough to be an investor on your own?
Yeah, and especially like being diversified, I think is important too, which I think Dan can speak to that. But a lot of real estate investors tend to be heavily concentrated into that. And when you're heavily concentrated, especially in Canada or in one specific market, then you become even more dependent on that market. So having that diversification with is across sectors, geographies, I think it can help weather tough times, definitely.
Thank you guys very much. Dan, did you want to say one more thing? It looked like you had something on the tip of your tongue.
No, I just think that it was funny where you're arriving at with your conclusion, because there is no one size fits all answer. Like every single investor and individual is different, and that's why the disclaimer doesn't even have to be embedded. It's a legitimate part of the conversation, which is like this is all just information, and it's not stuff that you can apply to like any person. And that's why I sort of use the average. It's like, well, for the average Canadian, yeah, like houses have been good. But if you're not the average Canadian, then it's you have to really, really think of like, what are the things? Do I need savings? Am I disciplined enough to just dollar cost average into the BMO ETF or the S&P 500? That's like probably the best place to start your actual discussion of the comparison of stocks versus real estate.
That's a great closing point. Anything else you guys want to close out on before we end today's episode?
No, Dan said it perfectly.
Okay, lovely. Thank you both so much for joining us today, and hopefully we'll have you back soon.